All right, welcome to another explainer. Today, we've got a fascinating matchup based on full year FY25 actuals. In one corner, we have the absolute gold standard giant of the Indian banking sector, HDFC Bank. And in the other, the ambitious mid-transformation challenger, IDFC First Bank. We're going to break down the numbers, their moats, and the hidden risks to see exactly how they stack up.
But first, welcome to Stressfree Investing Analysis Personal Notes. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. Okay, let's dive into this. Here is our roadmap for today. We'll quickly introduce our contenders, look at their scale and balance sheet strength, dig into profitability and growth metrics, evaluate their moats and management risks, and finally, give you our final verdict and framework. Round 1. Introduction and the contenders. Let the matchup begin. So, looking at the overarching identities here, HDFC Bank is what we call the gold standard giant. It's India's largest private bank, basically a massive compounding machine that just deepened its dominance with that huge HDFC Lod merger. Contrast that with IDFC First Bank, our mid-transformation challenger. These guys are undergoing a massive transition right now, shifting from a legacy infrastructure lender to a highly ambitious, retail-focused universal bank. So we're looking at two completely different stages of corporate life cycles.
Moving right along to round 2, scale and balance sheet strength.
When we look at the sheer footprint, the difference in scale is literally staggering. HDFC Bank boasts a market cap of over 1.5 million crore rupees, and its total assets, an eye-watering 4.39 million crore rupees. To put that into perspective for you, HDFC's assets are larger than the GDP of a lot of medium-sized countries. That makes its asset base nearly 13 times larger than IDFC First Bank's 343,000 crores. So yeah, HDFC wins this category purely by being a financial behemoth with unmatched systemic importance. You can visually see that gap in operational size right here. Looking at the FY25 revenue side by side, it's night and day. HDFC is pulling in over 336,000 crore rupees compared to IDFC's 36,500 crores. Sure, IDFC is growing, but they are playing in entirely different weight classes when we talk about total revenue generation. But here is the most shocking multiplier from the FY25 data: 47x. HDFC Bank's profit after tax, or PAT, is an unbelievable 47 times larger than IDFC First Bank's. We're talking over 70,000 crores in profit for HDFC versus just 1,490 crores for IDFC. That massive gap tells us we really need to look beyond just the top-line revenue, We need to figure out how efficiently they're turning that revenue into actual earnings.
Which brings us to round 3, profitability and growth metrics. Let's see how effectively these banks generate returns.
This reveals some absolutely critical insights. Let's look at return on equity, or ROE, which is a huge metric for banks. HDFC delivers a robust 14.5%. That's high-quality earnings right there. IDFC, on the other hand, is sitting at an ROE of just 4.2% for FY25, which is honestly well below its cost of capital. HDFC also boasts a PAT margin of 21% and vastly superior return on assets. But ironically, despite all of this, IDFC actually trades at a higher price-to-earnings multiple of 35.4 over the trailing 12 months. Why? Mostly because their earnings base is temporarily depressed right now. Now, what's really interesting here is the net interest margin, or NIM, basically the spread between what a bank earns on loans and what it pays out on deposits. Surprisingly, IDFC actually takes the win on this one. They're boasting a NIM proxy of about 6.03% compared to HDFC's 3.62%. Why the difference? Well, IDFC has been super strategic about focusing on a high-yield retail and microfinance mix, meaning they can charge higher interest rates on those specific types of loans. But as we know, higher yields almost always come with higher risks. Just look at this timeline of IDFC First Bank's recent profits. They had this amazing turnaround story building right up to FY24, hitting nearly 3,000 crores in profit. But then look at FY25. Profit literally collapsed by 49% down to just 1,490 crores. So the big question is, what exactly caused half of their profits to just vanish in a single year?
To answer that, let's jump to round 4, moats, management, and risks. Let's get into the why behind these numbers.
Let's kick things off with HDFC Bank's qualitative profile. Honestly, their moat is undeniable. They are the giant. They have a dominant retail, corporate, and wholesale presence, and that recent mega merger with HDFC LT just massively deepened their mortgage moat. They are a fundamentally solid compounding machine. But what's the catch? Their main risk right now is integrating that massive merger. They are facing some near-term NIM compression as they drag through repricing legacy, high-cost liabilities, all while trying to heavily build out their deposit base.
On the flip side, remember that crazy 49% profit drop for IDFC? Well, the culprit is MFI stress. If you're not familiar, microfinance institution stress basically means elevated defaults and non-performing assets, or NPAs, in unsecured microloans given to low-income borrowers. It's a sector-wide headache in India right now, affecting a bunch of banks. But it has hammered IDFC's bottom line incredibly hard in FY25, leading to some really elevated credit costs.
So the whole thing with IDFC is understanding this delicate balance of innovation versus risk. On the plus side, they have excellent management. V. Vaidyanathan is highly regarded, especially for his transparent communication and his retail-first strategy. And they've got a fantastic digital presence with their Indie app. But we can't ignore the live risks here. They are severe. That MFI portfolio stress is a heavy anchor dragging them down. Plus, there is a very real risk of equity dilution. They might need to raise more capital via a QIP or qualified institutional placement, just to fund growth while navigating these stressed assets. And if that happens, it could further weigh down their per-share metrics.
All right, time for round 5, final verdict and framework. How do we turn all this data into actionable takeaways? Let's synthesize all this. We ran both banks through our weighted scorecard, grading them out of 100 based on the FY25 data. And as you can see, HDFC Bank's unmatched profitability, its ironclad balance sheet, and top-tier governance earn it a dominant total score of 84 out of 100. IDFC First Bank, which obviously gets dragged down heavily by that recent profitability hit and the lingering MFI risks, scores a 67 out of 100.
So what does this mean for our final investment framework? Well, for HDFC Bank, the verdict is a hold or accumulate on dips. It's really a conservative core holding for a 3 to 5 year horizon. The primary upside trigger here is just waiting for that inevitable NIM recovery. IDFC First Bank, on the other hand, is strictly a speculative, high-risk watch. This is for the high-risk contrarian profiles out there. The stock might look cheap if you're just glancing at price to book, but honestly, it's a bit of a value trap unless profitability actually recovers. You really need high conviction that management can sort out this MFI stress and get earnings back to normal over the next few years.
Before we wrap up, a quick but important disclaimer. The analysis shared in this video is for educational and informational purposes only. I am not a CBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a CBI-registered professional before making any financial decisions.
If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below, and it might be the subject of my next video. Thank you for watching and keep your investing stress-free.